Let me say that again. 84 million bank account records. If you live in the UK and you have any financial connection to a country abroad, who then forwards that data to HMRC. Every year, your NRE account interest reported. Your NRO, when you dispose of a non-reporting offshore fund, like an Indian mutual fund, your gain is not taxed as a capital gain. It is taxed as... Now let us talk about what is actually at stake. A client of mine walked into my office last month, holding a letter from HMRC. His hands were shaking. The letter said HMRC had information about undeclared interest income and capital gains on his Indian mutual funds, and they were giving him one chance to come clean before they took further action. He looked at me and said, "My father set up that mutual fund for me 20 years ago. I redeemed part of it during COVID to help pay off my mortgage. I had no idea I needed to tell HMRC. He did not know what was coming. He did not know that HMRC had been quietly building a case against him for years. He did not know that the penalty could now reach up to 200% of the tax owed. And he did not know the most dangerous part of all, which I will get to in a moment. This is not a one-off story. This is happening across the UK right now. Thousands of letters are being sent to UK residents with assets in India, Pakistan, Bangladesh, Nepal, the Gulf, and beyond. The numbers are extraordinary. According to BDO, one of the biggest accounting firms in the UK, HMRC received 84 million bank account records in a single year, covering 1 in 10 UK citizens. Let me say that again. 84 million bank account records. If you live in the UK and you have any financial connection to a country abroad, there is a very high chance that HMRC already has your data. But how did this happen? It all started in 2014 with a quiet agreement most people never heard of. It is called the Common Reporting Standard, the CRS. It was developed by the OECD in 2014, and by 2017, over 100 countries had signed up to share financial account information with each other automatically, every single year. India joined in 2017, the UK joined in 2017, and every year since, Indian banks, mutual fund houses, and asset management companies have been quietly reporting your accounts to the Indian Tax Authority, who then forwards that data to HMRC. Every year, your NRE account interest reported, your NRO account interest reported, your fixed deposit returns reported, your mutual fund redemptions reported through your pen, your account balance at year-end reported. You may not have received a single notification about it, but the data has been flowing for 9 years now. And HMRC has been building Connect, HMRC's data matching system, one of the most sophisticated in the world, cross-referencing your UK tax return against every piece of foreign data they receive. When a discrepancy appears, a letter is generated. That is what arrived on my client's desk. That is what may be arriving on yours. But here is the part that even most UK accountants do not understand, and this is where the real damage happens. You see, HMRC keeps a list of approved offshore funds called the reporting funds list. If a fund is on that list, the UK treats your gains as capital gains, taxed at lower rates. If a fund is not on that list, something very different happens. I checked the list. Not a single Indian mutual fund is on it. When you dispose of a non-reporting offshore fund, like an Indian mutual fund, your gain is not taxed as a capital gain. It is taxed as offshore income gain at your highest marginal rate of income tax, which can be up to 45%. There is no annual capital gains tax allowance. There is no lower capital gains tax rate. And if you made a loss, you cannot offset that loss against the gain. Most people I speak to assume their Indian mutual fund gains are treated like UK shares. They are not. A gain of £50,000 on an Indian mutual fund for a higher rate UK taxpayer could mean over £20,000 of UK tax, even after any Indian tax already paid through foreign tax credit relief. This is the silent bomb sitting inside thousands of UK Indian portfolios, and HMRC knows. So what does the letter actually say? It tells you HMRC has information that you may have undeclared offshore income or gains. It invites you to use the Worldwide Disclosure Facility to put your affairs in order. It often includes something called a Certificate of Tax Position, which the letter asks you to sign and return. Now, I need to say this carefully. If you have received one of these letters, Do not sign anything without taking professional advice. The certificate of tax position is not a neutral document. Signing it incorrectly can have serious consequences. This is industry consensus across every major UK tax firm. They all say the same thing: take advice before responding. Because the letter is the start of a 90-day window and every day matters, now let us talk about what is actually at stake. The Worldwide Disclosure Facility penalties are not fixed. They depend on three things: your behavior. Did you make an innocent mistake? Were you careless? Or was it deliberate? The territory where your assets are held, and whether your disclosure is unprompted. Here are the verified figures. For tax years where failure to correct rules apply, if you come forward voluntarily before HMRC contacts you, the minimum penalty is 100% of the unpaid tax. If HMRC contacts you first, the minimum is 150%. HMRC can typically go back 12 tax years for offshore matters. That means 12 years of tax, 12 years of interest, and 12 years of compounding penalties. The Worldwide Disclosure Facility does not offer immunity from criminal prosecution. In serious cases of deliberate fraud, HMRC may use Code of Practice 9 instead. This is not theoretical. HMRC has been actively prosecuting offshore tax evasion cases for years. But here is the silver lining. For genuinely innocent or careless errors, if you come forward voluntarily with full cooperation, penalties can be significantly lower. In some cases, substantially reduced. So, if any of this applies to you, what do you actually do? Step 1. Do not panic and do not ignore. Both are equally dangerous. Step 2. Take stock if you have any of the following abroad: mutual funds, NRE or NRO accounts, fixed deposits, rental property, shares, insurance policies, or even forgotten bank accounts. Step 3. Get specialist advice before contacting HMRC. This is not a standard accountancy job. It is a tax investigation specialism. Speak to someone who handles WDF cases regularly. Step 4. If a disclosure is needed, notify HMRC of your intention to disclose through the Digital Disclosure Service. Within 15 days, HMRC issues you a disclosure reference number. From that moment, you have 90 days to submit your full disclosure that includes all unreported income and gains, tax owed, interest, self-assessed penalty rate, and a declaration of asset value. You must also pay the amount you owe at the time of submission, or have a time to pay arrangement in place. It is intense, but it is finite. Done correctly, it draws a line under the issue and gives you peace of mind. There is one more thing you need to know. From April 2025, the UK changed the rules for everyone. The old non-dom regime is gone. If you are a UK tax resident, you are now taxed on your worldwide income and gains, regardless of your domicile status. Even if your parents are in India, even if you plan to return one day, even if your assets are all in your home country, if you live in the UK, HMRC wants to know about all of it. This change has expanded the scope massively. For most of us, ordinary working professionals, doctors, engineers, accountants, shop owners with a modest inheritance, a mutual fund, a rental property back home, this change quietly affects you too. My client, the one whose hands were shaking, he acted quickly. We took advice. We made a disclosure. It was difficult, but it is being resolved. Had he ignored the letter, the outcome would have been very different. If you have any financial connection to a country outside the UK, take this seriously. Speak to a qualified UK tax advisor, specifically one who handles worldwide disclosure cases, before HMRC speaks to you. I'm building this channel to help people understand UK tax in plain language, especially for the diaspora. If this video has helped, subscribe, comment below, and share it, because the letter you do not want to receive is the one you could have prevented. This video is general information, not personal tax advice. Speak to a qualified UK tax advisor.